This is an investment analysis of Caffeine's Public. Caffeine is a motor dealer and was established over 140 years ago. Caffeine employs about 450 people and has 8 franchises in southeast of England. Caffeine does not only sell new and used cars, but also has after-sale service like car repair. For Caffeine's strategy, it mainly focuses on the premium and premium volume market. The company believes the stronger market will bring higher return on fewer but bigger sites. So, relocation and expansion of business took place during the year. Caffeine also has strategy for risk management, cooperation, and social responsibilities. For example, how to deal with varied used car price and how to benefit employers. In 2015, there are 2 significant operations, sold 3 freehold sites, and changed pension scheme from RPI to CPI. Now we're gonna analyze the group financial performance during the year 2015. For the income statement, we can see that the used car market and after-sale market helped to increase revenue for the year by around 9% and increase gross profit by around 8%. Note 1 indicate in the annual report that no major customer amounting to 10% or more of the group's revenue, which means the group is in a steadily profitable business. This suggests that there has been an increase in volume of goods sold, which outweigh the increase in cost of goods sold. Furthermore, the decrease in administration expenses and increase from other income contributes to the 550% increase in profit for the year. After factoring in comprehensive income statement, the total comprehensive income for the year amounted to an increase of 130%. After a glance at the balance sheet, the working capital of Caffeine appears to be healthy, which is an increase of around 50%. This is mainly due to an increase in total asset of around 9%, despite an increase in current liabilities, which is caused by an increase of payables. The significant increase in net asset, around 36%, and a retained earning of about 50%, indicate the business is prospering, which is in line with the company's expansion efforts. As for the cash performance, there is a net income in cash and cash equivalent in 2015, which is of a smallest percentage compared to 2014 by around 50%. This is due to a reduction in cash inflow from operating activities, which outweighs the decrease in cash outflows in investing and financing activities. In all, the cash and cash equivalents at the end of the year increased by around 280%. The cash position of the company is beyond satisfaction, and it might help to pay off liabilities and to achieve its expansion goal. For further analysis, we chose a competitor named Lucas, because both companies are UK-based and selling the similar brand cars, and Lucas' condition are close to the average market figures. The main tool we use is the ratio analysis, and in the following analysis, non-underlying items are included. As for the profitability, the significant increase in ROCE of 30% in this year is mainly due to the increase in net profit margin. This implies that the company is utilizing its resources well. The extraordinary performance of the company in this year is mainly due to an exceptional £8.86 million non-underlying gain in the benefit pension scheme. Also, the group's investment property at Uckfield was sold for around £0.43 million, and a freehold property in Lewes was sold with a net gain of around £0.39 million. Nevertheless, there is an increase in underlying net profit, which is mainly attributed to high volume of sales and better management of costs. The other component of ROCE is efficiency of asset utilization to generate revenues measured by net asset turnover. Caffeine's net asset turnover, around 4.8 times, is marginally better than the previous year's number of around 4.5 times. The significant increase in ROE shows that the company is able to generate value and increase shareholder wealth through profit. In comparison with Lucas, The higher ROE and ROCE of Caffeine shows that it has a greater ability to utilize its capital to generate profit and to manage costs. As for liquidity, although the current ratio are above 1, after removing inventories, the liquid ratio are well below the ratio of 1, which is a cause of concern. Moreover, as for cash ratio, Caffeine achieved around 4.7% this year compared to 1.5% last year, and its operating cash flow ratio has a considerably high level of around 11% in this year. Thus, the company's cash flow cycle is relatively stable. Overall, current and liquid ratio of both companies are similar. It might be the industry norm since retailing can operate with liquidity ratio below 1.
As for the efficiency, in 2015, Caffeine has longer inventory holding period of 1 day, and this is not a cause of concern. The payable payments period increased by 3 days, which suggests that company has improved negotiations with suppliers on payment terms. Overall, the cash-to-cash cycle in 2015 is 43 days compared to 45 days in 2014. The cash-to-cash cycle is slightly improved, but do note that assumptions are made by using revenue instead of credit sales. Compared with its competitor, Caffeine is better than Lucas in terms of efficiency. As for gearing, the capital structure of company is such that they would prefer to finance company with more equity as compared to debt. Capital requirements imposed externally by the group's bankers are that bank borrowing should not exceed 80% of the current value of group's freehold properties, which are subject to a fixed charge. Caffeine's gearing ratio is 42%, lower than the previous of 67%. Even so, the gearing ratio is still relatively high as the company could save costs since interest is tax deductible, and the cost of borrowing is outweighed by earnings. Note that the company is able to comfortably pay interest with a cover of 7.4 times. Both companies have a good control of long-term debt and covering interest with operating profit, but Caffeine has a higher proportion of debt as a percentage of equity, indicates that it is riskier than Lucas. This is due to the redevelopment work at a number of Caffeine sites, which requires a high amount of investment.
Now let's move on to trend analysis. For revenue, there has been a continuous increase since 2013. For finance expense, there has been a steady increase from 2011 to 2014 and a tremendous decrease from 2014 to 2015. The sharp increase in non-underlying items from 2014 to 2015 have led to large rise in profit after tax. However, the trend analysis disregarded the impact of inflation. For example, an upward trend in reported accounting data may have static or even declining performances in real terms during periods of high inflation.
In consideration of the market, Caffeine has seen an increase in its share price over the years from 2014 to present, with share price ranging closing from 495 to 645p at its highest point. The last share price on 10 February 2016 closed at a price of 550p. This range of company share price is backed up by its strong performance along with the robust industry trends, as seen in the following slides. New car registrations increased by 7% in 2015, which is the highest half performance record. The low interest rates and attractive financial deals, combined with a wealth of the new models, have continued to encourage customers to purchase new cars. It can be observed that the overall outlook of the UK automobile industry is positive. Out of the top 10 selling models in 2014, Caffeine has franchises in 5 out of 10 models. Also, out of used car transactions, Caffeine has franchises in 4 of the 10 models. It can be seen that the price-earnings ratio in 2015 is 6.91, reflecting a lower figure from 2014, which is mainly due to the increase in earnings per share and net income. Dividends payout is 517,000 compared to 360,000 in 2014, which is an increase of 43.6%. This stemmed from increase in total dividends per share from 18p in 2014 to 20.25p in 2015. Although there is an increase in dividend yield, the high reinvestment of earnings outweighed the dividend payout, which explains the lower price-earnings ratio. It can be extracted from the annual report that the company will continue to invest its proceeds from the sale of properties and close operations by acquiring additional land to grow the existing businesses. The company is concentrating on larger business properties in stronger markets to deliver higher returns on capital from fewer but bigger sites. It can be seen in the diagram below that dividend payout is approximately 6% of earnings. Cavens has been reinvesting earnings to generate growth to create value for shareholders, and now the company is attaining positive results on its reinvestment efforts. For example, the focus on improving operational processes has seen an encouraging increase in used car sales and in after-sales. Looking at the price-earning growth ratio, it can be observed that the higher PEG of 2.01 is contributed by a decrease in growth rate, since there is a decrease in price-earning ratio, while a low PE ratio makes it signify the stock is undervalued. Factoring in the company's growth rate and could paint a different story. In a sense, the lower the PEG ratio, the more stock may be undervalued given its earning performance. In this case, it is highly likely that the PEG has increased due to the growth slowing down, as expansion plans are mostly completed or are due for completion. Nevertheless, the economic growth in the UK remaining encouraging, and manufacturing continue to support the automobile retails market with strong finance-led offers. Through growth in the private and small business sector has slowed in 2015, and new car margins are slightly reduced, customer confidence remains to be steady. Also, in terms of dividend yield and total shareholder return, Cavens is outperforming the retail industry and FTSE Small Cap Index as seen in the diagrams. Similar to its competitors Lookers, Cavens has reaped results in its efforts to improve customer retentions and sales growth. Despite the potential decline in growth, Cavens has strong fundamentals and the stock is undervalued given its marginally low PE ratio. The company is also able to comfortably pay dividends with a dividend cover of 4.17%. There is value created for shareholders with reinvestment of earnings and also income to be earned in the form of dividends. The team also deduced that used car sellers and after-sales business will continue to help boost earnings of the company. So, in the conclusion, the team proposed to buy the stock. Attention, some issues should be considered. First, the risk of bad debt. Trade receivable this year increased by about £2 million, which increased the risk of bad debts and potential decrease in profits in the following years. Second, moral hazard in auditor-company relationship. Grant Thornton UK LLP has been the auditor of Cavens for more than 10 years, and this could pose as an issue due to close ties leading to biased auditing and inaccurate reports. Third, risk of overstating earnings through depreciation. The team has noted that the depreciation was conducted over the useful life of 50 years, which could be too long of a duration and may as a result of understate expenses and overstate earnings. That's all of our presentations, and thank you for your attention.